Welcome to the Hotel News Now Podcast Network. This episode of the Next Gen in Lodging podcast dives into the challenges and opportunities around financing hotels in today's market. Host Chris Henry is joined by guests Dave Jacoby, founder and managing principal at SOAR Advisory Services, and Will Moncrief, founder and CEO of Sidecar Suites. Jacoby and Moncrief talk about how they funded their latest hotel projects, and they share tips for how to approach hotel financing in today's economic climate. Thanks for listening.
Hello and welcome to the latest edition of Next Gen in Lodging podcast, brought to you by Hotel News Now and CoStar. I'm Chris Henry, and I will be the facilitator of today's episode. With me today, I have my good friend Dave Jacoby and Will Moncrief, who are joining us both from Texas. We're going to learn a little bit more about them and their properties, but also about how they went about getting financing in the current economic climate. So first off, Dave, if you could tell us a little bit about yourself and your hotel.
Sure. Thank you. It's a pleasure to be here, and thanks for having us. So I was born and raised in Philadelphia and somehow ended up in Galveston, Texas. I'm still not quite fully sure how it happened, but went to school up in the Northeast, did my undergraduate at UPenn, and like just about everyone in my school, ended up in New York. My career took me into financial consulting, where I consulted on throughout a lot of different industries, but got focused into a casino and resort kind of section where I was working with various different casino industry companies. Got to know that industry very well and moved on to graduate school at Cornell. They've got a hospitality and real estate program, did that. Moved out to Las Vegas and worked with the kind of top three people that had just left Las Vegas Sands and was starting a new company that was a joint venture between themselves and Cantor Fitzgerald, the investment bank. Worked there for a few years, helped develop a casino in Manila and the Bahamas, then kind of broke off from that group and an offshoot from that group and developed a hotel casino on behalf of one of those owners in Las Vegas, and kind of got to do a development on my own in that setting. And during that time, got married to my wife, who's from Galveston, had our first of what is now 4 kids, and decided we wanted to move back home as we were growing our family. I call it home now, it is, but it was where she was born and raised. So we moved here, and Galveston is an awesome city. If you're not familiar, it is about 45-ish minutes from Houston. It's a beach city. It's got a lot of history to it, a lot of Victorian architecture. It's a major port, or formerly was a even more major port here in the United States. And it's got a lot of tourism here. We wanted to bring kind of a new generation of tourism to Galveston, so found a mid-century modern hotel that was in somewhat disrepair, but was still operating, and took it down to the studs and renovated to a high-end boutique, kind of more progressive F&B forward product. And we just opened last November of 23. So we're getting our initial kinks out, ramping up, and gearing up for our high season here, which is the summer.
Perfect. And what's the name of the hotel?
Oh, neglected to say that. Thank you. Hotel Lucine.
Hotel Lucine. Well, I can say, having been out there in February, it is a very cool and quaint boutique hotel with a very loving and caring staff. So you should be very proud, Dave, of what you guys accomplished.
Thank you.
And Will, tell us a little bit about yourself and what you and your partners are working on.
Yeah, Chris, thank you so much for having me on the podcast. Excited to be here. My path into the hospitality is really kind of a grassroots or organic journey, in the fact that I've worked in investment management for several large banks over the last 7 years, and initially just worked predominantly with business owners in the real estate space. Started investing in single family properties myself, initially long term, and then started looking at the numbers on the short term rental side and converted everything over and started really building out that portfolio, which initially then kind of transitioned into doing some master lease agreements right outside of after COVID in 2021, when a lot of these large multifamily developer owners were having some vacancy issues, and then from there continue to grow the portfolio by acquiring more properties, as well as starting to incorporate in a property management arm. And so my path initially from Fort Worth, Texas, where I now reside, and we've started our own hospitality brand, which I'll touch on here in a second, and then spent 2.5 years out in Los Angeles working at JP Morgan out there on the wealth management side, and that's actually when I was started purchasing real estate properties, and when I met you as well. And so it's interesting how, you can start as just a secondary income source and as a true, investor. And one thing led to another, and I just started gravitating more and more into that real estate space and really falling in love with providing just an incredible guest experience and continuing to just fine tune the operations, be an incredible operator, make the numbers really pop, and then over time scale and continue to grow the portfolio. And so where we are now did move back to Texas, and we started what we are calling a lifestyle hospitality company called Outpost Casitas. So we're building micro resorts in urban infill locations, with the first location being in Fort Worth, Texas, our backyard. And then we're building a sister project under the Outpost name in Arlington, Texas, about 4 to 5 blocks from AT&T Stadium, also Globe Life Park where the Rangers play, as well as Texas Live and several other kind of large amenities. They just added the Medal of Honor National Museum as well. So a lot going on there. But our project consists initially of 31 casita villas and 6 Airstream trailers, and then really the kind of the integrity of the project is the courtyard in the middle. So we have focused our dwelling units, kind of on the perimeter of each of the landscapes, and really prioritized the centralized courtyard where we have a lot of outdoor amenities and lights, and really trying to create a unique experience. And so excited to get into the discussion, and I'll hand it back to you.
Will, appreciate you sharing that information, and excited to see your projects as they continue to develop. I know from the plans and renderings you've shared, it looks like it'll be a fun concept.
Yeah,
So,
absolutely. We're excited.
So from that point, Will, I'm hearing more and more from folks who are saying, hey, look, I started on single family, then got into multifamily, and now I want to jump into hotels. Where for you did that evolution take place? What sort of led you to jump from one to the next?
Yeah, I think one, obviously seeing the financial potential there, but more so, I fell in love with hospitality. I really did, and I'll try to make this answer a little bit more concise. But working in wealth management for 7 to 8 years, mostly in the private bank, white glove service was always kind of the motto that we incorporated with our clients, and really tried to kind of transfer over that same level and standard of service and quality into all of the individual units that we had. And there's just something about that, being able to have a tangible product where you can create an experience, but then also offer that service that just for me, truly, it just kind of made it kind of was a magical type deal. And so you want to continue to grow and build upon that. And so it was an evolution of doing, there's 2 routes. This is kind of the way I looked at it. One would be to keep the portfolio relatively consolidated and go, 1031, do larger properties, get larger kind of vacation type rentals, or go the other route, which would be to scale into, larger commercial type projects. And so we I opted for the latter, and initially was looking for what I think is probably a little bit more prominent in the market right now, where folks that are strong short-term rental operators are going out and they're looking for undervalued assets or underperforming hotel motels, and going in, purchasing it, rehabbing the product, refinancing it, and then incorporating in kind of more of a streamlined short-term rental type operation package that has much lower overhead and is and for the most part is automated. And so we were looking to get into more of the kind of that forte, if you will, and inevitably came across just an amazing piece of property. And as we started thinking about building out a true kind of traditional boutique hotel, 4 stories with a 5th-story rooftop, we got the renderings, we did the modeling, we're speaking with the banks, and it was just, unfortunately, it was in a very difficult capital markets time. And I think we're still, to an extent, in that window, is in 2000, late 2022, early 2023. Initially, that project was going to be about 80 doors, and it was going to be approximately 30 to 35 million. And we went to all kinds of different capital market folks, including you and your group, Chris, and just had a hard time, tackling a project of that size at that time, being first time developers. And so what we opted to do is kind of circle back to, what is a core competency, working with a business partner who did have real estate development experience and former attorney, and kind of his strengths were not mine, and vice versa. And so good partnership. And we opted to, I was like, what are the things that really have been effective in the portfolio that we have had? And that truly was, location, unique experiences, and amenities. And so as I opted and looked at several folks that have had success in kind of doing these micro type resorts, albeit they were all in rural areas, kind of in the sticks, we found areas that we believed from a land purchase perspective, I was like, I really think we could incorporate in a similar type product. And so won't go to all the ins and outs yet, at least of how we kind of created Outposts, but what was essentially produced was more in that $9 to $12 million type project size. And we found that that was something that we were able to get much more comfortable with from equity and debt perspective.
Amazing. Appreciate that overview. And it's definitely a journey you guys have been on. Dave, how did you take Vegas, which the numbers that come out of Vegas are so big, it's sometimes hard to get our minds around. How did you take that experience and knowledge and sort of pick it up and move it to Texas and say, hey, look, we're going to start working on boutique hotels? How did that transition and thought process come about?
Yeah, I mean, so oddly, the first project I ever raised money for and was at the helm of was like $165 million casino resort, which I don't think is not normally people's first entree into development. But delivered the project on time and on budget. And once I moved back here to Galveston, I want to do something a little more for me. That was something I did on behalf of other developers and was kind of handed a business model, and it was something I was not the target customer for, but figured it out. I wanted to do something that was a little more my vision, was a little more something I believed in, and just being used to larger scales. Something Will said a moment ago, where he was looking for, originally set out to do projects in the 35-ish million range. I was kind of looking at some projects of that scale also in and around the Galveston area, and they all required me to be partnering with somebody else who owned a big chunk of land, or requiring some large investor who was going to call the shots in some significant way that was going to put me in a working for somebody else capacity, or just put me in a scenario where I'm not in the driver's seat. And I didn't want to do that. I wanted to kind of look at a project that I could really put my vision into. So scaled it down and did a project, again, similar to the size where it sounds like Will ended up. And that's kind of how I got here. And there were definitely some learning lessons along the way. In some regards, doing a much larger project, things that were smaller were more digestible. Particularly, some of the fundraising was easier, but some of it was harder too. A lot of the contacts I had wouldn't write a check as small as I needed, which wasn't, what I was anticipating going in. And for larger construction projects, you can get better general contractors and different groups to help you work on the development that can make things go a little smoother. So I just found both instances were very hands-on, but maybe even a little more different than I would have expected.
It's really interesting that both of you bring up the $35 million project, Black Hole. It's something that even we as a company run into quite frequently, that it seems to be anything that's over 25 million starts becoming too big for, call it, the private investor or high net worth guys. But if it's under, 100 million, it's too small for the big investment funds. And,
Hmm.
we have our large project in Austin right now with 2 hotels as part of it. And, our capital raise for equity is in the $80 million range. And we genuinely have groups saying that's not big enough for us to cut an equity check, come back another time. And it's just mind boggling sometimes. So there does seem to be that void in the market for financing for projects. So I think for both of you, especially Will, because I know when we looked at yours, that was one of the challenges there.
Yeah,
So,
absolutely. Yeah.
so, you know, with both of your projects, maybe Will, you could start first. How are you structuring, in a general sense, the financial capital raise?
Yeah, so we basically broke ours down into kind of 2 equity tranches, if you will. We initially raised a friends and family round where we worked with the bank, and we're just trying to acquire the land, and we had to do it from an assemblage standpoint. We had to do it in like 3 to 4 different acquisitions. So we went into what truly was still, it was the last kind of remaining houses left in this particular area. So as I had mentioned, we're urban infill, and everything outside of about these 9 single family parcels was restaurants, bars, retail, all of that. And so unfortunately it was 3 different owners, sellers. And so we had to go in there and kind of purchase that at different times. But fortunately for the first purchase that we made on the land, it was one seller, 6 different pieces of property all right next to each other. And we went and got a interest only land loan for a year with the bank. And then basically went to our friends and family, raised an initial quick round to basically cover the land value and soft cost. And then came back, really decided, during that time exactly what we wanted to build, and came to the conclusion of doing this about $12 million project consisting of just under 40 doors, with some of the outdoor amenities and whatnot. And so we went in and essentially raised the remaining equity through primarily, high net worth folks, previous clients, whatnot. There was like a family office and one kind of private equity type institution involved. And that basically closed out our equity raise, which is fantastic. And then we might not, it's up to you if you want to kind of jump into it now, but our biggest challenge on the debt side came in the form of basically getting a third party guarantor to sign off on the note, which is kind of a story in itself. So happy
Well,
to
hang on to that one. We'll get into the stories in a second. But what's the percentage of debt and equity split on your
Oh,
project?
sorry. It is 70-30.
Okay, perfect.
So
And the bank, are you using just bank financing, or do you have any PACE or other type of instruments involved?
Yeah. So we did look at PACE. We did look at some alternative options. We did look at mezz debt, but eventually we did settle with doing just a kind of pure traditional construction loan. It's at 70% debt to 30% equity.
And Dave, I know because I randomly bumped into one of your investors. I know you did a lot of family and friends raise as part of your cap stack, but can you give us a breakdown of sort of what you went through to raise both the debt and equity?
Sure. So, the Hotel Lucine, or the building that preceded it, was not for sale, and I wasn't sure it was going to become for sale. So I spent some time working out a deal with the prior owner, and when I reached one, I thought, "Oh no, now I got to go raise all this money." So, negotiated a long due diligence period and went out and started raising friends and family. Started with some folks, in and around the Galveston area that I thought had a connection to this project, and in the Houston area, which is our large feeder market, and kind of quickly found that there were a lot of people that wanted something like what we're building here, kind of a more progressive lifestyle boutique hotel that just didn't have one, and were intrigued by the idea. So raised friends and family in really small chunks. The vast majority of our investors are $50,000 and below. And we're about 60-40 debt to equity. We have I think 65-ish individual investors, and some of those are entities that have a few individual investors within themselves. And we could have consolidated more and had fewer larger investors, which I think is, the natural inclination of what folks think they normally would do. I kind of like this model because everyone that's an investor in this project is either in hospitality in Houston or Austin or one of our feeder markets, or in a creative industry that has some relation to or connection with Hotel Lucine. And that allows us to essentially have an ambassador network built in from the opening of this project. So you get word of mouth, you get culture carriers out there in your, the networks that you think you want them in. And people are, literally and figuratively invested in your project. And then from a debt standpoint, we were kind of, I don't know, the 6th or 7th inning of COVID, let's say, is when we were going out for debt. And I'm sure we all remember that time was not an easy time in the capital markets. We were able to finance our construction loan, and now refi just recently closed about a couple of weeks ago on another piece to get our construction loan out, in both instances with no personal guarantee, which was sort of an important aspect for us. We were able to get terms from a lender for our construction debt that I was able to get a local high net worth investor to slightly beat, roughly match, but in a lot more of a relaxed environment where we could work things out with him if there were any issues along the way. And that was definitely really helpful for the project. And then as we refied more recently, not signing a personal guarantee was pretty important for members of our team, so we kept it that way. And that's where we are now.
And this is sort of a question for both of you. When you're doing a friends and family raise, because I think I'm in the odd situation where I was always raised by my grandfather and father of not doing friends and family raises in case something goes wrong, that you don't want to be liable to them and have that affect the relationship. But with the number of investors that you guys have, how are you managing, or how did you build in the right guardrails so that if things do go wrong, or if somebody does want to cash out earlier than the other partners, how does that mechanism work?
I mean, I could speak for myself. I'm not sure what Will would say here, but I guess there's a few things I'd say. One is that risk is right. Your grandfather's not wrong. That risk is on the table, and you can do what you can to mitigate it and be super transparent and take the time with each individual investor to answer their questions or tour them around, or give them whatever access to any information they need. But ultimately, that risk is part of the process, and it's something you have to be willing to endure. But I think really just being upfront and transparent about the risks and being available when they need you or they want you, or they've got a question, just being patient and spending the time with them, and being proactive when something might come up but hasn't come up yet, I really think is at least the way I deal with it. Will, I don't know if you have a different answer.
I completely agree with you. And I mean, coming from the background that I did, like being a good fiduciary and a manager of folks' hard-earned money, I mean, it's of utmost importance. And I would say that, like, I don't necessarily rely on the friends and family. I'll be honest, like we were building a nice kind of name for ourselves, for niche in this business. And so it's one of those things where I think it's important for you to go to the people closest to you initially. I mean, if for anything else, for other contacts and resources, to express, hey, look, we're building something special over here. And all of those folks, they wanted to be a part of it. And I think I agree with, Dave's comments. It's just about creating a very clean structure, being extremely transparent with it, having a strong business model that's very thought through, and showing the upfront risk and kind of rewards as well, and just making sure that you're conservative on your estimates. But in my case, it certainly wasn't a position where you're going out with open hands out, looking for some help. It's more so like folks really more so coming to us that were very close, that wanted to be a part of it and really believed in the vision.
Yeah,
And
and
I
I'll
think,
I'll also add to that sorry, one unintentional outcome here that I found as I got into it, having so many investors was something we did deliberately so that we would have this, ambassador base, like I said. But it also turned out that nobody really bet the farm on this investment, and there were no institutional investors here who were going to lose their jobs or had to close out their fund and needed to cash out. I mean, there just weren't instances like that. So in some respects, investor relations to my investors is harder because there's just more people to discuss with. But in other respects, people aren't pushing as hard as often because of the nature of what this investment means relative to the rest of their portfolios.
and when you, I guess, worst case scenario, if something did go wrong in your, I guess, agreement, your placement agreements with these folks, is there a particular workout situation that you found people are more comfortable with, should the worst happen? Or is it, hey, we'll figure that out when we get there, if we get there and we don't want to be there?
I mean, for our project, there's various safeguards where investors have the right to vote folks out and make certain decisions if they want to collectively decide to do so. We operate our project. We operate it at the privilege of our investors, and they're able to change that if that's something they decide they want to do. We don't have the ability for any investor to just redeem themselves at every time. We have had issues where there was an important personal issue one of our investors had and needed to get redeemed, and we were able to figure out a way to do that. So, kind of on a best efforts basis with some of those items. Will, I'm not sure how you'd handle that.
Yeah, I mean, outside of exactly what you just said, we don't have really any special clauses in there. I mean, every investor is different, right? And I also agree that, I was very familiar for the most part with each of these folks and kind of like, their financial background and whatnot. And so I think some may dig into let's walk through kind of a worst case scenario, but in most instances that wasn't really discussed because it could be so many different things, right? But generally, I mean, we didn't have a whole lot of pushback. I mean, we didn't put any really special clauses in there, but we've been flexible. I would echo what Dave said. We had one particular investor that actually needed to kind of withdraw out, and we're happy to do that. But had a personal matter come up, and we were able to replace that equity relatively quickly. But yeah, I mean, I think we really broke down. We got great bank terms. We bought the land at a fantastic price. We bought that a year ago. It's at $60 a square foot. It's appreciated, and the new appraisal came in at 80. So we've got a nice equity cushion. We've really tried to be very, very communicative, and reaching out on a monthly basis, if not more. Because we're not hiding the fact that we're first-time developers, and we've been operating and have a significant portfolio at this point. But that is very much, we're going to be as transparent as we can, and we've built a fantastic team around us, and we're really leaning on the experience there as well.
So, Will, you brought up a really interesting word a minute ago of fiduciary. And, one of the things I've been seeing and being approached about by clients is, hey, there are these folks who are trying to raise money, and they're encouraging people to either cash out IRAs or 401ks or take home line equities, equities out of their home and invest in their hotels. And a lot of the groups who I've encountered doing that and hearing about that tend to be first-time developers or similar to yourself, started a multifamily, moved into hospitality. Do you, just based on your background, having worked in the banking industry, do you feel like that's a prudent or sustainable model because from my perspective, they are asking people to risk their nest egg to support them on trying to do a project. Does that, from a banking perspective, does that feel right to you, or does that sound a little shady?
Well, I kind of laugh about it because if I put back on my banking hat, I would tend to steer people away from that. But then again, obviously as bankers, we're looking holistically over the whole portfolio, but tend to be very careful about, any kind of selling away or, being very cautious to encourage and or support your clients investing in outside private investments that, frankly, we haven't really been able to do a ton of due diligence on. As far as like being able to leverage retirement vehicles and or really anything of that such to invest in real estate, I know that has become kind of a popular option. I frankly did not have any clients kind of participate in that. I mean, majority of our clients at the time, like they had pretty significant real estate portfolios, but never tapped into it from a retirement aspect. I think it goes back to just the fact that, I mean, generally speaking, private investments are going to be a bit more speculative. So the fact that you're pulling money out of a, retirement account to invest in a speculative investment, especially if it's with just, a closer friend or family, like you really got to do some significant, due diligence on that and make sure that it's something that fits kind of your client or your profile, but also that it's a sound investment.
Absolutely.
Yeah, I would agree with that, and also kind of echo that I do not want to be in the position of advising someone how to collect the assets on their end to invest in my project. That's up to them. That's not my area of expertise, and I'm not here to advise them on their overall investment strategy. I can tell them about my project and what we plan to do, and I pretend to be I'm an expert there. I don't pretend to be an expert in whatever their financial planning is. So I always advise people, if they have any questions about anything like that, go talk to your CPA, your advisor, if you have a financial planner, whoever that is, spouse, talk to your people about it and come up with your own strategy. All I can tell you is what we're working on here.
Yeah, and I think both of you said it really best. It's you got to do your due diligence, you got to do your understanding, and be prepared for the risk. I was just curious to get, because I'm seeing more and more of that. So back to your both of your projects, when you went out to, especially on the debt side now, when you went out to put together construction financing, did you have any issues with the banks, with your projects not having a big brand or flag or affiliation on it, since both of yours are going to go fully independent?
I'll jump in there. I mean, we did not, but I will say that as you know, Chris, I mean, really, it's interesting what you want to define kind of our brand as, right? I mean, initially my vision was truly to get into the boutique hotel game, and really we're carving out kind of a niche of hybrids of sort where we're between a more traditional short-term rental product, albeit there a bunch of them, and a true boutique hotel. It'll be interesting to see if we really stick to this specific model, which we're trying to keep lean, low cost, and take advantage of all the cash generating short-term rental advantages with not having the higher overhead and operational cost of a traditional hotel. But I say all that in that when we approached banks, they didn't really fully understand exactly what it was, right? And so it was hard for them to bucket us into a particular category. So to be completely upfront, I probably went to 10 to 12 banks. 4 said yes, maybe 5 of the 10 to 12. So at the time, I thought it was a decent batting average there, but a majority, all but 2, basically said we're not going to be able to lend more than 60%, and that's because that's just kind of what our limit is on hospitality type projects, and we're defining this really as a hotel. Whereas the other 2, they really underwrote this more so as kind of like a short-term rental type product, if you will, and so there was just more flexibility on that end. But as far as having a brand, even for the folks that were, going to take on the project and give us those 60% terms, they never asked about, whether it was going to be a flag or not. I think if I recall and talking with one of them, for them it did not matter. Like the terms like probably wouldn't have adjusted. I would find that hard to believe. I would definitely think that having a flag would get you would be an advantage working with the banks. But given the fact that we did not have that, it wasn't something that we really deeply explored.
And how about Dave? How about for you, whether on Hotel Lucene or back in your Vegas days?
Yeah, I mean, certainly here at Hotel Lucene, the topic came up. I mean, we were able to navigate around it, but there were some groups that are, um, that dabble in hospitality that maybe aren't primary. Hospitality is not their primary asset class of investment, and those folks tended to want something a little more predictable. They want you to build the eighth Holiday Inn Express in a 400-mile radius, and they know exactly what it's going to do, and they can just run the supply demand traps on it. And we were, Galveston has a lot of flagged hotels. They don't have a true boutique experience until now, really, at least of this style. So that was really sort of core to what our identity was. So we wanted to make sure we stuck to it. I also sort of look at a lot of these flagged, a lot of what you have to pay into to get into a reservation system for a national or sometimes international affiliation. All of our customers are coming from Houston, Dallas, Austin, and San Antonio. Almost all of them from Houston. So it felt like I was paying for a broader reach than I really needed. I really just need people within a 3-hour drive of me, and mostly within a 1-hour drive of me.
It's funny you say that, because on our Austin project, we ran into that a lot with sort of out-of-state investors, both on the debt and equity sides, where they didn't quite grasp how much of an internal market Texas is.
Yeah.
They kept coming back, well, why would somebody from New York or LA want to come to Texas? Like, we want to be on the coast. And it was a very interesting dynamic that, Texans like Texas, and it drives room nights there.
It's true.
That is so true.
So Will, I know you mentioned that you had an interesting story to share on when it came to debt and raising it for your project. You want to enlighten us a little bit there? I'm intrigued to learn more.
Yeah, well, I mean, it's funny how you do what you need to do to get a deal across the finish line. So, and having this opportunity to be able to talk on your podcast, it's not ever anything that I guess we take pride in, but it is how we got there, and hopefully it can help other people. And I would start that also by saying I would love to hear how Dave was able to get across the finish line with no personal guarantees, because that
I'll never tell.
yeah, because that's what tripped us up. And so and I'll try to make it quick. So the banks got very comfortable with the underwriting, but as you can imagine, they're like, look, we'll give you a 70% loan to cost here, but you're going to have a sizable third-party guarantor to come in here and sign off on a $9 million note with a pretty healthy balance sheet. And one of the things they said is like, hey, you and your business partner qualify. What I asked them, how much would we qualify for if we did not go get another guarantor? And we explored that market, and they said 55%. So I was like, okay. So, they said, look, we'll give you a 55% term sheet and a 70% term sheet. With the 55%, we then, went out and explored mezzanine debt. And I've since spoken to some people that are like, oh, I thought it was 10 to 13%. Of the groups that we spoke with, predominantly in Dallas, it was ranging more in the like 16 to 18% range. And as you can imagine, some very like kind of strict clauses and whatnot. And so, I mean, it felt icky. I mean, it felt uncomfortable. And so we were thinking through, okay, we'll continue, running dual pass, trying to find a significant third-party guarantor. But again, being a first kind of a relatively novel idea, new project, first time developer, business partner had some experience in it, but for the most part, this is kind of our first big project. And so, there's apprehension on signing on that note, and understandably so. And so what we actually ended up doing is going back to the bank and presenting an option where we said, look, what is the delta between that 55% loan to cost and 70% loan to cost? And it was $2 million. We said, if we bring you $2 million in cash, similar to a mezzanine debt structure, will you collateralize against that and give us the full 70%, term? That's good for the bank. They get deposits, they get the, larger loan size. And they said yes. And so what we did is we had kind of baked in a cash guarantor, guarantor cash compensation component, dialed that up a little bit, and then basically went out back to our investors and said, we're going to raise a private credit opportunity. It's kind of, I don't know if we're calling you guys investors, lenders, or guarantors, but here's the deal. We got $2 million. We're going to break it into 4 shares. It's going to be basically based on a burn off with the bank on a DSCR ratio as a trailing 6 month. And so we modeled out it would be about 2 months to, we're stabilized and we would be able to burn off, that obligation. And what we're going to do is we're going to put your capital into a 2-year CD earning 4. And then we're going to pay out this, cash guarantor piece, day one, distributed out. And so, just that cash component was like about a 13.5% annualized return, a little over that, 13.7 on a 2-year basis. And if you, obviously top on the 4% CD, it really got to where it was, 17, 18%. It became pretty attractive opportunity. And they were basically held, at the same level in the capital stack, mezzanine, senior to equity, junior to the bank debt. And given the fact that we had such a significant appreciation on the land, there was about a $5 million equity cushion before that capital would even be kind of impacted. And so as people kind of analyze the risk reward profile there, we, we're able to work together to legal and put that together. And that was how we were able to essentially complete kind of the debt side for our permanent financing.
So it sounds like you had to do a little bit of a dance there to get it done, but you managed to pull it together.
Yeah, I keep telling all my developer buddies, I'm like, man, you guys said this was easy, and like they just die laughing. And I was like, I feel like we're started on a small, much smaller bite size than a lot of the folks that we know in the multifamily and hotel space that are doing significant project sizes. But this has just been an incredible learning opportunity. We were able to get over a lot of hurdles, and just feeling really good about the project. But no, it certainly isn't a breeze. And so you got to get a creative, and you got to bring some creative partners that are willing to listen and be adaptive as well into the mix.
And Dave, do you got any wild stories on your financing for your project?
Not quite as much financial gymnastics as what Will just said there, but we weren't really dealing with traditional banks. At least the kind of small regional banks around here, weren't willing to look at us or really any hospitality projects around that time. And then with there being kind of stress in that layer of the banking world in the ensuing few months, that became even less of an option. And even still, as we refinanced, folks were not, those types of banks just needed to see, at least 6 months, really a year of trailing 12 of performance, and we just couldn't show that. So what we ended up doing for our refinancing is going with a USDA loan. So for folks that aren't familiar with that, it's similar in concept to an SBA loan, a Small Business Association loan, whereby it's a federal government-backed program where the federal government will back 80% of a loan to a participating bank. The bank puts forward 20%, unguaranteed by the government, and then they select projects accordingly. FDA loans are restricted to areas of certain populations, which oddly Galveston is. We have a 50,000 person permanent population. It's probably a little more than that with the next census coming out, but over 8 million visitors a year. So it doesn't feel that small, but by the letter of the USDA program law, we complied. So we were eligible for that program. So I will tell you, it's any project where you want to go on a private industry pace and you're involving the government, things go a lot slower. And it was, we would complete whatever we needed to complete and get it into the government's hands, and there it would sit, and we'd wait and wait and wait and wait and then get something back. So what should have been call it a 90-day close was probably double or more of that amount of time, which certainly was stressful right out of the gates, and we had obligations to meet and construction loans to pay back and working capital to sort through. But we got there and landed the plane on it. But that was about as crazy as we got.
Dave, was your rate below market or about at market?
It's hard to say what market was for our asset at that time, because we were new to this market, a new style of asset in this market, and we were just opening, so couldn't really prove any operations yet. And we're the first of our group's development together. So it's not like we could point to projects, 1, 2, and 3, and now this is 4. But I mean, we were able to get, in kind of the high single digits. And that'll reset over time as prime resets.
Yeah, I'm just curious because we looked at that avenue as well, and I've got a a mentor who has 4 or so hotels, and they went that route, and it ended up working very nicely for them. But and they got a fantastic rate, much more attractive than going a traditional bank route. But he said very similar sentiment. It's just super slow process, so you got to be really patient, more paperwork. But after the fact, he's like, man, I mean, it looks beautifully from a financial standpoint, but a bit painful to get through.
It is. I had some history in working in the EB5 world, which is excruciatingly painful. So my, for better for worse, my tolerance for government red tape is pretty high.
Yeah. You're primed for it. Yeah.
Out of curiosity, since we brought up the USDA loans, are there any other mechanisms, Dave, that you guys looked at that would be, not traditional bank debt?
Yeah, PACE came up earlier, and we looked at that. I think we looked at it off and on like 3 times and ended up not taking it. And in the end, I kind of wish I did take it. So we sort of teetered on the brink of it a few times.
What was the reason there? Why didn't you take it, and why do you wish you've taken it?
We didn't take it because it was a little bit unclear how much we were going to qualify for. We're not the biggest project, so if we were a little bit larger, it probably would have been, made more obvious sense. And then we were able to solve for our capital stack without that. But then as we went through design, we ended up increasing the scale of our development and needed additional capital to come in. So we sort of looked at PACE again around that time. And again, decided we could do it with our internal resources. And then finally, as I mentioned, the USDA loan was taking longer than we thought it would. The terms were roughly comparable, what we were seeing on PACE versus what we were seeing on USDA. So we were considering just, reducing our USDA intake and slotting in some PACE, and then decided that the USDA would come in fast enough that it didn't, it provided us no timing advantage. So we might as well just stick with 1 product versus 2. Ultimately, that assumption was incorrect, and USDA took even longer than we thought. So that's why I sort of wish I did, just from a timing perspective. It would have made us opening right into the off season a little bit more flexible. And for a project like ours, we're a mid-century modern building built in 1963 that we took basically down to the studs and then redesigned back up to a higher end boutique. Just about everything we were doing naturally was qualifying for PACE anyway. So for listeners here who aren't familiar with PACE, an ultra simplified overview of the program is if you are providing energy sustainable additions or improvements to a project where currently where those additions didn't previously exist, you can qualify for some portion of that spend to be applied as a tax assessment. So it sits with the building. So if we were to sell, if we were to take in PACE financing, sell the building, that obligation would sit with the building. It wouldn't be something that would be tied to our entity in the same way that a loan would.
And Will, how about you guys? And with your Fort Worth project, was there anything else that you considered other than bank debt? Any other government programs or alternative programs?
No, I mean, we did, as mentioned previously, look at the USDA program, and then when we were going out to kind of try to potentially fill that private credit gap, whether it be mezzanine debt or of any source, we looked at PACE financing as well, and then we went to a couple private credit groups that were like 2 million's too small, and they actually looked at potentially just doing a direct loan with them for the full amount, and so we did look at kind of some specific smaller type institutions that had an appetite for that. And then I never pursued specifically the family offices on the credit side, but I do know very kind of different, a little bit of a different, obviously, asset class. But I've got a good friend who invests in the multifamily space, and they leverage family offices essentially as their bank for all their projects. So I mean, there are, I think, a couple other options kind of privately, but not anything I necessarily would recommend in this particular market. It's going to be much tougher terms, I feel like.
Yeah, no, it's certainly a sign of the times. Terms aren't easy these days. I think that's why everybody right now is just trying to find what avenue is the least painful to keep things moving. So as we
I'll add there, I found that the family office route was maybe the most variable. We got both the best and worst term sheets we looked at throughout our financing process through different family offices. So um, I don't know. And whereas when we looked at traditional banks, there was a pretty tight range. When we looked at PACE financing, there was an even tighter range. So I don't know. At least that was my experience. But I found some of the private family offices and private wealth individuals to be good avenues, and some not.
Well, I think we've seen the same too on our project, Dave. In Austin, is that the family offices are really sort of filling the void and gaps right now left by the, I guess, more traditional lending institutions. They're really the ones who are keeping the market moving forward right now.
I believe, I feel like the market is getting tougher, and I mean, we're a little bit not quite out of the woods, but it's interesting. I went to a real estate luncheon last week, and there's a large build to rent guy who's kind of all across the Southeast, and he said that on their most recent project, I don't know the exact size, but north of 20 million, he reached out to 100 different banks and only received 3 term sheets back. And I mean, again, it's one small sample size, take it with a grain of salt, but it just, your eyes kind of like eyebrows perk up, and you're like, I mean, is it really getting that tight? But what we've seen is we went back to a few of the banks that initially said yes, as we were kind of potentially going to renegotiate terms as we were putting on the permanent financing from the interest only land loan. And a lot of those folks said, man, you need to stick with whatever relationship you have in place right now. It's a difficult market, and we've tightened the belt up a bit. So for what that's worth, I don't think have loosened any.
Interesting. Did you see by any chance yesterday Jamie Dimon's sort of, I guess, annual report that he shared?
I haven't. I've read them in the past, but I did not see the most recent.
Well, the only reason I bring this up is because the biggest takeaway of it was that inflation is still too high, jobs are still growing too fast, and I guess JP Morgan, that they have scenarios, played out and in place for 8% interest rates. So I'm just curious. I didn't know if you'd read it or not, or what your takeaway was from it. But 8% base rate, that's really going to hurt, unfortunately.
Yeah, I mean, I wasn't able to give it a read, but I certainly will look into it. And it does seem like there's all this sentiment that's been building up of lowering rates, and we've been talking about it for a while, and it certainly hasn't happened yet. It continues to keep getting pushed out, and so I think for folks listening, nobody's got a crystal ball in all this, and you hesitate to kind of throw out any type of projections, but I think we're going to certainly be in a range of, this, at best case, 6 to 8% for a while. And if it stair steps down, back half of this year, great. But I do think you kind of have to have a conservative expectation on that it could stay flatter than most are hoping for longer.
I would agree with that, and I think that's a commercial for some of those alternative products we talked about before, like Pace or other areas that do are not completely immune to what the rest of the market looks like. But I've looked at a lot of other projects here in Galveston, given the historical kind of supply of buildings we have here, and historic tax credits become a lot more attractive in environments like this. You sort of just need to look at other ways to supplement your capital stack if your base rate isn't going to help you out.
Absolutely. Absolutely. Well, guys, we're coming to the end of our time together here. And so I guess our final question I'm going to ask each of you is just almost bullet point wise, your top 3 recommendations to our listeners if they're going out to try to get financing for their projects. So Dave, why don't you lead us off?
Okay. In no particular order, because this was I wasn't prepared for a list question here.
Sorry about that.
I would say that's fine. I would say, don't be shy. Ask whoever you think might not be a good fit. But some of the best meetings I've had were meetings that I thought this isn't going to be a fit, but I'll do it because so and so told me they should, and it works out great. So, don't be shy and keep an open mind. I would say, always follow up with people. Again, I'd say maybe our largest investors were people that initially said, absolutely not, I'm out, no way. And just kept in touch with them, not in like a pushy resale kind of way, but just kept in touch. And those people came around. And, believe in what you do. It sounds cheesy or trite, but, I don't find I'm really passionate about this project, and I tend to throw my whole self into the things I work on. And I never have to prepare for an investor meeting. Let me put it that way, because I know exactly what I know. And I know the numbers, I know the building, I know the marketing, I know it because I live it. And if you care about it that way, that comes through to other people, and not just because you have the answer to their question, but because they can see that dedication in you.
Appreciate that. Will, how about you?
Yeah, I mean, I think we talked about a lot of different options there, and my biggest takeaway is exhaust all options. Like, I mean, you're not going to be penalized from trying out every single route, and so you really got to hustle, and you have to scrap, and you have to ask for introductions. I really do believe let your friends and family know what you're doing, and don't go out in a form of handouts. Go in a form of like, hey, this is what we're doing. To Dave's point, super confident, passionate about the business model. Like, here's what we need to get, have an ask and ask for introductions to really tap into your local network first and foremost. And then if you're looking for deals, I mean, I love the idea of seller financing. Very few things like, really pencil right now. And so start, depending on what it is, like maybe it is a undervalued asset or underperforming asset or whatnot in the hospitality space, being a hotel or an older multifamily complex and potentially be converted, whatever it may be. I do believe, although there it might not be as plentiful as some may allude to, like there are a lot of baby boomers out there that have had assets for a long time with a lot of equity in it, and so you've got an ability to go out there and seller finance and really structure something creatively. So I would lean into that and always make sure that you make the ask to the seller. And that's kind of a topic, a whole nother topic of this discussion. And then secondly, like we went back to our investors, like if you've got folks that have deep pockets, family offices, that type, like I just said, like the people will do direct deals with you. Now they might not be attractive terms, but deals are there to be had. There's a lot of dry powder out there right now, and the terms are going to be tough. But like, I mean, do your homework, underwrite the project, make sure that you budget for it conservatively, and then you got to kind of get out there and see every option that's available.
Thank you for sharing that. And gents, I want to thank you both for participating in this latest edition of Next Gen in Lodging.
Hi, I'm Isaac Colazo, Vice President of Analytics at STR.
Hi, and I'm Jan Freitag, National Director for Hospitality Analytics for the CoStar Group. Tune in to our new show, Tell Me More, a hospitality data podcast.
It's a podcast on the global hotel industry, its current trends, what we're thinking about, and where the industry's going.
And we like to have fun with the data too. Find us on hotelnewsnow.com or wherever you listen to podcasts. Subscribe today.
This episode of the Next Gen in Lodging podcast was recorded on April 9, 2024. It was edited by Rachel Daub. Next Gen in Lodging is part of the Hotel News Now podcast network. Find all hotel industry news at hotelnewsnow.com. Subscribe to this and all Hotel News Now podcasts wherever you like to listen. Just search for Hotel News Now. Thank you.